let me start with you, if I can. Tell us about the property nat cat market the property cat market in 2022.
Well, Anthony, thanks for the question. The risk landscape has changed, right, over the past, I would say, 18 to 24 months. And really, it started many, many years ago, about 6-7 years ago. On the one hand, in 2022, you had geopolitical tensions that arose. We have a war in the Ukraine. And that led to an energy crisis and obviously also led to an inflation that we haven't seen for decades. We also had supply chain disruptions persist, and even to today, right, we still see supply chain issues that arise, and also that fuels inflation. And finally, we have different claims expectations or post-claims expectations, so this so-called social inflation that we also see in the numbers flow through. So this is quite a bit of a changing risk landscape. Add to that the mediocre, underwhelming return that we as reinsurers have been achieving over the past 6-7 years due to the elevated net cat activity that we have seen. So on average, in the Sigma report, it's written it's about 110 billion a year over the past 6 years, so from 17 to 2022, fueled by mostly secondary perils. It means that inevitably led to a review of the returns and a review of risk appetite and the review of certain actors to be in that line of business at all. So clearly that risk landscape changing, that mediocre results resulted in what we consider to be a hard market today with tightening terms and conditions, increased rates, and clearly also higher retentions, which were necessary given the inflationary environment and the activity that we've seen over the past 6-7 years. I would just say this as well. There was distress in the market, right? By the end of November, December last year, it has become much more orderly in terms of the activities and the trades that we've seen. We have seen at 1/1 and now at 4/1. But clearly, the return requirements haven't gone away. The increased retentions that we've seen in the market continue, and also the tighter terms and conditions and clarifying wordings topic is still there.
Right. And there's quite a bit of sort of macroeconomic content in there. Jerome, do you just want to give us a bit of a sense of the macroeconomic situation in 2022 as well?
No, very happy to do so. And building also on what Gianfranco just said, in 2022, the risk landscape he mentioned really changed. And that's also very much driven by the economic environment we have been in 2022. We called the Sigma the perfect storm, and definitely it was a very perfect storm in terms of economic storm. And I think 2022 will go down as the year where actually the economic hurricane of force 5 hit the shore or made landfall in the global economy. And I think it's also super important, and hurricane force 5 is a super rare event. It happens every 40 years, and this is what we have been seeing in 2022 and still are fighting today. Inflation is at 40-year high levels, be it in the US or also in Europe. However, I think what is really important is that we don't forget where we have been coming from before 2022. Now it's true that we had the start of the war in Europe in Ukraine. We had the energy crisis, energy prices. This was a huge stagflationary shock. Fact is, however, before the war, if you look at the numbers before the war, and let's remember, it's not so long ago, before the war, inflation was already in the US at a 40-year high. If you look at the numbers before the war, 7.5% for CPI in the US, and actually already the highest ever for the Eurozone. I think that's important assessment that before the war it was already we were already in a stagflationary-like shock. It's important because it means the road ahead is going to be much more complex and probably multi-year. Maybe one point to add, right, to make also the connection to the Nat Cat Sigma and today's environment, and Gianfranco alluded to that. If you look at the sectors that this inflation tsunami has been affected the most, if you look in the US, it's the construction sector, and in Europe very much similar. And if you look at the figures, right, replacement costs over 2 years in the US, they increased by a staggering 40%. So definitely it's an inflation tsunami, and we are still living through that tsunami or hurricane. Maybe to keep that analogy of a hurricane in mind. 2022 will go down as the year it hit landfall, in my view. But I think the good news is that probably the eye of the storm, also the peak of inflation, is behind us. But as so often with storm, hurricanes or tsunamis, the rebuilding is very complex. Yeah.
Absolutely. So a lot of pressure in the system. Martin, tell us a little bit about the modelling aspects of that then.
Happy to reflect, and as you mentioned, the perfect storm, and I remember, Jerome, we discussing on that title. From an NatCat perspective, 2020, from our research angle, it's not that special. It's a lot of insured losses. 125 billion is way above the average of the last 10 years. But nevertheless, you made reference to a Hurricane Cat 5. We didn't have that on the NatCat side. So the events physically weren't that special. What made 2020 special is that around the globe we were hitting again big value concentration. Started with Hurricane Ian in Florida, hitting a densely populated coast. In Australia, hitting densely built up areas with the flooding. And also the hailstorms in France, leading to record losses we've never seen before in Europe from hailstorms, also affecting just way more population, way more values out there in 2022. So not a perfect storm, more kind of a recurring of a pattern we've seen, and that's relating back to what you say, a changed risk landscape. From NatCat perspective, we take maybe a step back and say, well, it's the last 6-7 years. 2022 is just reconfirming what we've seen there. And if you take even one bigger step back, actually, and look at a few decades of experience, actually, it's back to normal. It's not a new normal, what we experienced since 2017. It's back to normal, while normal is not a steady state. It's growth. Every year, 5 to 7%, and it's quite a robust figure over 2-3 decades, 5 to 7% of where these insured losses grow. Inflation adjusted, so not even relating to the inflation you mentioned. So you have to just get used again that we had a bit of a benign period from 2012 to 16, which made us feel maybe also in the industry a bit too comfortable that something has changed, while it just nature came back. 2017 first, this is the new normal. Now, 6 years after, I think we start to get used to, no, this is just the normal. 100 billion and plus of insured losses per year.
Thank you, Martin. That's great. And so we really have a context now that's 2022 and how we got to here. Gianfranco, tell us a little bit about 2023. How we got, we know how we got to here now. Tell us about how you see it now and into the future.
I would summarize it in continued market momentum, right? And this has two big sides and two big factors. One is the supply side. I'll start there. To regain confidence in the NatCat space, right? From an investor standpoint, we need to be able to deliver earnings. We need to be able to deliver returns that are commensurate with the volatility that we see in this business. And we haven't been able to do so in the past years. So that's a prerequisite from, at least from our point of view, for new capital coming in. So clearly, that's the supply side. Diversification helps, but we've also seen, based on what Martin just said, a trend. And trend is diversification, right? From a portfolio construction point of view. So that's why the high retentions and the tighter terms of conditions and the rate increases are so important. On the demand side, there's clearly a fueled demand that we've seen also at 1/1 and 4/1, and we believe it continues. We've seen it also with some of the US players at 5 and 6/1, that this inflation elements, higher limits and elements the need for more cat reinsurance placements. So clearly the supply is disciplined, is there, but it's disciplined, and the demand is going up, and therefore also the price equilibrium, as we know, moves up. But I would say the topics, the issues will continue to persist. Also at 7/1, it's mostly a US and an Australia renewal, and we see the same and similar patterns that we've seen in the past renewals in those geographies.
Mm-hmm. Thank you. So Martin, the severity of events appears to be getting worse. Urbanization clearly a part of that. Tell us a bit more about that.
There's a good point you make about severity in particular. As in that whole mix, you would often read nowadays, well, the frequency, the number of events is increasing as much as maybe severity. Our research has shown actually that severity has been growing over the last 4 decades by about a factor of 8, while the number of events only about a factor of 3. So that's just according of what we monitor within Sigma, our research, which tells us a story that we have to get severity right in particular. And I think the good news there is that the models we are using across the industry, particularly for, I call it now peak perils, so US hurricane, earthquake perils, they've led us a long way to kind of build a sustainable business model for the tail end. I think where the industry in its best practice is still in a learning mode, is to address also the body of the distribution, the frequency end, the earnings, where you mentioned before secondary perils, with all vagueness what secondary perils is, but come in where model practices are less developed. We have to add in more discipline and stay sometimes on the sideline if this discipline isn't there, kind of to apply the same rigor in terms of creating exposure data, kind of sharing that, using models where models are available. But again, the good news is these models work once you start to use them. So creating that sustainable basis of understanding that risk, I think it's also an important contribution to create more sustainability, more trust in this market also by outside investors.
Mm-hmm. Mm-hmm. Can I just build on what Martin said, and also a request to all the guests that are joining here us today. The request is on data and data transparency. It'll help us and the industry tremendously if we have access to data that is more granular than what we typically receive from submissions and what we see in dealing with in the trades with clients, and also clearly by partnering and really exchanging on what our insureds and our clients are doing in terms of how they, how you manage risk is super important for us, and enables us better quality modeling and better quality discussions.
Mm-hmm. Absolutely. Thank you, Gianfranco. And just to the audience, we'll just pop up on the screen now the QR code for you to use. You can also go to slido.com and use the hashtag SRNatCat to ask your questions. First questions are just coming in. I'll try and weave them in where I can into the dialogue, but of course we are still on time to have a number of good questions at the end. So we look forward to your questions. Please do send them in. Jerome, we were sort of talking about where we are now, where we're going. A lot of this, of course, doesn't happen in isolation in the industry. We're talking about a macroeconomic context. As you were saying before, it's a really interesting one. Give us a bit more about how you see it now. What's your baseline scenario for 2023 and going forward?
Our baseline scenario is inflationary recessions. And inflationary recessions for the global economy and the bigger advanced economies, it means continued high inflation. Yes, we do expect inflation to come down further, and in the US, for headline inflation to come down to 4%. Eurozone a little bit higher to 5%. But at the same time, we are seeing that growth is slowing down. We see on a global base, actually, that manufacturing sector is probably in a recession, not the service industry. And we do expect actually a mild recession in the US for the second half of this year. So that's our baseline scenario, high inflation. And I think it's super important. If inflation is coming down, it is still very high, and it doesn't mean that prices are coming down. I think from an underwriting perspective, colleagues here will appreciate, and I think it's also important, linking to what Martin, you just said before, while the frequency of NatCat events, yes, it's increasing, but not as much as severity. If that inflation shock in the system, yes, it dissipates, but it doesn't dissipate so quickly. It also means that there's still going to be continued likely stress in the system. So continued higher economic losses on NatCat front, just to build on what you mentioned. So growth likely coming down, inflation also coming down. That's the good news. As I mentioned before, the peak in terms of inflation shock is probably behind us. From a central bank perspective. Today we had a Bank of England hiking 25 basis points. They are not done yet. The ECB hiked last week 25 basis points. They are for sure not done yet either. The Fed has also hiked, and they're probably, at least for now, done. However, we could see continued risk, even in the US, that the Fed will have to hike further from 5% plus area in a kind of a stop-and-go manner. And why? Because inflation. Maybe actually inflation is like a diet. Losing the first kilos when you do a diet is pretty easy, and inflation, the first part of this inflation has been pretty easy. It's base effects, it's energy prices coming down, but maybe that analogy with a diet is not that bad, because it's really the progress at the end, getting and hitting that inflation target, which will be super challenging. And we at Swiss Re, we do not expect the central banks to be able to hit the inflation target either this year or next year. And maybe similar, that's my last point, to the diet. While you get the target, inflation target, maintaining that level is going to be hard. And we see this as one of the main downside risks, actually, that the inflation target of 2% is the usual inflation target generally recognized by the key central banks, that this signpost or this target is going to be moving upwards because it's so difficult, in our views, to reach that target. But for sure, it's going to be multi-year progress. So inflation, recessions, downside risks, and obviously huge uncertainty around it.
Right. It's a fascinating time for sure. Martin, looks like the hard market's here to stay now. What are the ways that people need to navigate through that? Give us the sort of the modelling perspective there.
I would take a step back from maybe the hard market question, linking to Jerome, just repeating my message of before, kind of the new normal, the normal we have is a continuous growth also down the road. So this risk landscape will grow 5 to 7%. That's net of inflation. If we add in what Jerome mentioned before in terms of inflation, this is way more. It's about discipline, and clearly this fuels a bit this sentiment of hard market. I'd probably also underpin, we call it hard market in my more risk perspective. It's feeding in more, I call it price for this higher frequency we see. We call it secondary perils. What I mentioned before, this body of the distribution. This also needs money in the system. We see it on the primary side, the results in the US in Q1. There's a lot of nat cat in that mix. We see it on the reinsurance side, we discussed before, over the last 6 years. So this financing of that, it's kind of not only modeling, it's in the end also asking for money. I think that's fueling part of, you can call it hard market, but also resetting, finding a rebalance of what this system needs to remain sustainable.
Thank you. And then, Jerome, obviously you were just talking about the sort of the macroeconomic situation. It's quite relatively extraordinary, really, I think, for given the last decades and more. How can Swiss Re help clients in this situation?
I think pretty easy. Partnership, number one. Second, research analysis. This actually was the Sigma number one after 55 years of doing Sigma series, a flagship series of Swiss Re. And I think research and partnership are the key ingredients for innovative solutions and reinsurance solutions. And there's no doubt, I think in our minds, volatility is going to stay high. I think that's the key ingredients. And maybe I would like to add to that, let's also not forget the longer-term trajectory. Global protection gaps on the climate front, nat cat front, it's still very big, it's huge. 3/4 of the natural catastrophes are not insured, meaning whatever we can do with our partners, with our clients to narrow that protection gaps, we help ourselves and we help society. So that's a big reward out there, I think.
Great opportunity, absolutely, absolutely. And then, so Gianfranco, I mean, 1/7 renewals coming up. What are the conversations you're having with clients?
I would just pick on Jerome's point, right? We're in this together, and the more we drive the adequate pricing in the marketplace, both for your clients, but also for the reinsurance sector, the more we attract capital, and the more we build that resilience, and the more we can penetrate insurance markets with the right products. So it's a win-win-win. We have to get this right. Martin has mentioned it before. And so the themes will continue. Will continue also for the 7 ones that we will see upcoming and the 1 ones in Europe predominantly and the US. I don't see that trend reversing. We have to create the confidence, and we have to create the trust and the track record, right, to be able to attract this capital back. For Swiss Re, having a lot of capital back is typically not a good thing because it drives prices down. But at this stage, I wish some of that capital to come back rather quickly next year.
Mm-hmm. Great. Well, thank you very much indeed. I think we'll get to the questions now. Again, we'll just pop up the slide for you where you've got the QR code, but you can also just use your browser, go to slido.com and put in the code SRNatCat. We've had the first few questions. Jerome, I think the first one, we'll start with you on that, but I think maybe Gianfranco might also want to come in on this. Once capital does come back in, what do you think is needed to maintain that balance between demand and supply?
Well, I think one capital needs to come back, and if you look at the alternative capital space, it has been slow so far, but at some point it will come back. It's no doubt about that. However, I would say this market is very much different compared to the soft market and soft cycle that we had seen pre-crisis. First, we need stability in terms of market volatility. There are lots of other attractive opportunities out there, not just the alternative capital space. And if the capital comes back, it's also a good thing, right? But I think it will take time because we had seen such a huge imbalance, especially last year. I think, Gianfranco, you alluded to it. And fact is, if actually interest rates they spike further and increase further, and there's definitely a risk at the short end of the curve if central bankers continuing to hike. That also means a negative impact on shareholder equity. Mm-hmm. And that means the traditional capital space is more constrained. Mm-hmm. So yeah, I would wish the capital will come back. It will come back for sure, but I think it will take time.
I would agree with Jerome, right? We had 6-7 years of underwhelming returns. We need to build a track record that attracts capital back into this sector. It's an attractive opportunity for investors. I do believe in it. It's a fundamental value proposition of reinsurers and also insurers, right, to societies and to businesses. But clearly we need to establish that track record. Diversification helps. Diversification does not.
Okay. What's your expectation for following on 3 to 5 year on the CAT availability, unpredictability in terms of capacity, price, any opportunities that you see for cedents, Gianfranco?
So this, in terms of, can you read the question again, please?
Yeah, what is your expectation for following 3-5 year on the CAT availability, unpredictability in terms of capacity, price, any opportunities that you see for cedents?
Well, so first of all, I think the capacity, the net cat capacity will be available, right? It's a question of price, structure, and clarity of what is covered. And once we get that right, over the next 3 to 5 years, I don't expect a shortage of supply. Now, I say this bearing big events, right, which could distort that statement. On the other hand, there's an opportunity for cedents to review their own risk landscape, to rethink how much to self-retain, how much to purchase on top, and restructure the CAT programs. And there's maybe efficient ways to purchase CAT reinsurance going forward. I would always periodically review with partners such as ourselves or with broker partners. That give advice on how to do that. There is an opportunity to pass on the cost of reinsurance to the ultimate customer, and I think that's an important feature as well. Mm-hmm. That the pricing in the system, as Martin was alluding to, the premium that is available in the system is enough to cover the volatility that is inherent with Nat Cat.
Mm-hmm. If I may quickly complement to that, as we have not used one word so far, it's climate change. in that whole mix? And that's probably a question coming up very quickly. Is 3 to 5 years, do we see more of that in that whole mix, creating uncertainty? Yes, that's a factor which is somewhere in the mix, but for us it's not the key driver. And we are, in that sense, still absolutely convinced the business model of offering Nat Cat insurance and reinsurance isn't broken. It's a question of having enough money in there. There's gradual changes I mentioned before, and climate is one of it, but it's not kind of a step change we expect at all. So in that sense, the model isn't broken, but I think we have to more reliably finance also the smaller losses in the mix, to repeat something I mentioned before.
Yeah, Martin, I want to pick up on something because you and I had a conversation after the Nat Cat. Sigma came out immediately afterwards as well and did a video on that. We'll send a link to that to our audience afterwards. And we were talking about urbanization and the remarkable sort of changes that are taking place. Just tell us a bit more about that.
I mentioned before that we've, on a more decadal perspective, we get 5 to 7% inflation-adjusted growth. About 4 to 6% you can explain, 4 to 5% by GDP, global GDP growth, so quite easy value, whatever. Now, value growth doesn't happen like homogeneous across countries, it's happening in urban environments. And in addition, urban environments very often are close to waterways, to coasts. That's where traditionally, historically, cities have been built. So the hazard actually, the values also find more hazard. Coasts, rivers are just more hazardous. That's what we've seen in Australia last year, that we've seen in New Zealand this year. If you're close to waterways and the coast, you're just more exposed to that. So indeed, kind of monitoring the urbanization piece, where the models can be a very great help, as important as monitoring the climate change piece in that whole mix.
Yeah, thank you. And in the Sigma as well, we were talking about economic factors remaining the main drivers of rising losses. Jerome, talk to us a little bit about that.
Yeah, I think Martin alluded to it, right? Inflation-adjusted economic loss is one thing, but fact is we pay out nominally, right, and not in real terms. And the bad thing is if climate change hits, is that combination of climate change or natural catastrophes hitting natural catastrophes on the economic front. And again, inflation, disinflation, it's happening. The peak is behind us. There's no question in our view. And in order to have sustainable growth, you need to have price stability. It's the most important good that central banks provide. Besides being the lender of last resort, price stability is if you don't have it, you create such imbalances which are not just good for economic growth, but also not good for the societal and the peace of the society either. And it hits the natural catastrophes also in a disproportional manner. If you think about that, 3/4 of it are uninsured, and often the uninsured part, if you look at the country perspective, is then also in lower income regions or lower income countries. So it hits the worst off. But yeah, in terms of economic impact, probably 2023, bearing abnormalities. But if you look at the trends that we had seen in terms of what Martin alluded to, the frequency, inflation will be on top of it, will continue to be on top of it. And again, inflation is coming down, but prices is not coming down. This is, I think, super important. Yeah.
Okay. Look, I think we've already reached the end of the half hour, so thank you very much indeed for joining us today. I hope you found that interesting, and we'll send you a recording of the session immediately afterwards, and a copy of the Sigma, and of course some of the other collateral that we think will be interesting. Thank you very much for joining us today, and wish you a good day further.